Three names, Pets, Calm, Webvan, and Boo. Calm became symbols of a coming disaster. These weren't just companies, they were promises. Promises of a new economy where old rules didn't apply and fortunes were made overnight simply by adding calm to a business idea. The late 1990s buzzed with an intoxicating belief that the internet was an unstoppable force, a golden goose laying endless eggs. It was a gold rush, but instead of picks and shovels, the tools were venture capital and broadband connections. Valuations soared into the billions for companies with no revenue, sometimes no actual product, only a compelling PowerPoint presentation and a catchy domain name. The Nasdaq, the barometer for tech stocks, became a rocket ship. Everyone, it seemed, wanted a piece of the action. From seasoned Wall Street veterans to taxi drivers and grandmothers, investing in tech stocks became the national pastime. The fear of missing out, or FOMO, was palpable. Stories of instant millionaires fueled the frenzy, creating an unsustainable feedback loop. Startups burned through cash at an alarming rate, prioritizing market share and brand recognition over profitability. Lavish offices, expensive Super Bowl ads, and free perks for employees were the norm. They believed revenue would follow once they dominated their niche, a concept often dubbed "get big fast." Pets, Calm, for instance, spent millions on marketing, including a famous sock puppet mascot, to sell pet supplies online. They offered free shipping and deep discounts, operating on negative margins. Their stock price peaked at $14, then began its inevitable descent, a precursor of what was to come. But the party couldn't last forever. Economic indicators, once ignored, began to flash red. The Federal Reserve, under Alan Greenspan, started raising interest rates in 1999 to cool an overheating economy, making borrowing more expensive for these cash-hungry ventures. The writing was on the wall, but few wanted to read it. The first major crack appeared on Friday, March 10, 2000. The Nasdaq Composite Index hit its all-time high of 5,048.62. This date, unknown to most at the time, would mark the peak of the dot-com euphoria. What followed was a slow, agonizing unraveling. Over the next 2 years, the index would plummet by nearly 78%, wiping out trillions of dollars in market value. It wasn't a sudden crash, but a painful bleed. Every dip was met with hopes of a rebound, but each rally proved to be a dead cat bounce, only to fall further. The collapse of the dot-com bubble wasn't just about stocks. It was about broken dreams, lost jobs, and the shattering of a collective delusion. Companies that were once hailed as pioneers became cautionary tales, their innovative ideas proving unsustainable without a clear path to profit. Webvan, an online grocery delivery service, raised over $800 million and built state-of-the-art automated warehouses. They promised delivery within a 30-minute window, but the logistics were a nightmare and the costs insurmountable. They burned through their capital and declared bankruptcy in July 2001. Boo, Calm, a British online fashion retailer, launched in 1999 with an incredibly ambitious website that required high-speed internet, alienating most users. They spent $185 million in 18 months and went bust in May 2000, becoming one of the most infamous dot-com failures. Even established tech giants like Cisco and Intel saw their stock prices decimated. Cisco lost 86% of its value, and Intel dropped 80%. It was a stark reminder that even the strongest companies aren't immune to market irrationality or correction. The aftermath was grim. Layoffs swept through Silicon Valley and beyond. Thousands of highly skilled workers found themselves unemployed, and the once booming tech sector became a symbol of economic uncertainty. The term dot bomb entered the lexicon. Many blamed the venture capitalists who poured money into unproven concepts without sufficient due diligence. Others pointed fingers at investment banks that hyped IPOs and analysts who issued strong buy ratings on overvalued stocks, often with conflicts of interest. The accounting scandals that emerged in the wake of the bubble's burst, like Enron and WorldCom, further eroded public trust. These weren't dot-coms, but their fraudulent practices highlighted the broader corporate greed and lax oversight that characterized the era. The Enron scandal, in particular, was a masterclass in deception, manipulating financial statements to hide billions in debt and inflate earnings. When the truth emerged in late 2001, the energy giant collapsed, costing thousands of employees their jobs and pensions. WorldCom, another telecommunications giant, was found to have overstated assets by billions of dollars, leading to the largest accounting fraud in U.S. history at the time. Its CEO, Bernie Ebbers, was later sentenced to 25 years in prison. The Sarbanes-Oxley Act of 2002 was a direct response to these corporate malfeasances. It imposed stricter accounting and reporting standards for public companies, aiming to restore investor confidence and prevent future frauds. It was a clear attempt to mend a broken system. Yet despite the devastation, the dot-com bubble wasn't entirely a waste. It laid the groundwork for the internet infrastructure we rely on today. Fiber optic cables were laid, data centers built, and a generation of entrepreneurs gained invaluable, albeit painful, lessons. From the ashes of the bust, stronger, more resilient companies would eventually emerge. Giants like Amazon and eBay, which survived the crash, learned to focus on profitability and sustainable business models rather than just rapid growth at any cost. Their survival was a testament to adaptable strategy. The dot-com bubble served as a harsh, expensive lesson in market psychology and the dangers of speculative fever. It demonstrated that even revolutionary technology needs a sound business model, and that exuberance, unchecked, can lead to devastating consequences. The internet did change the world, just not in the way many had envisioned in the manic days of the late 90s. It took a painful correction to separate the truly transformative innovations from the ephemeral hype, paving the way for a more mature digital economy. Uncover the untold story of another market collapse in our next deep dive.